Hi, everyone. Welcome to Analyze Your Trade, episode number 56 for November 20th, 2018. We are broadcasting live on YouTube at 4:30 p.m. Eastern Time. And you can also listen to all the audio-only episode of every episode of the Timing Research shows as podcasts on your favorite podcast network like iTunes, Spotify, Stitcher. Just search for Timing Research and subscribe there. Today we will be discussing your trade ideas. So over the last few days, about 30 people submitted up to 5 symbols each, and you should be seeing the list on your screen now while I'm talking. So we're going to get through as many of those as we can. My name is David Kosmeter. I'm the creator of TimingResearch.com. And I developed this show with Dean Jenkins of Follow Me Trades, but he is off this week as moderator, and I have Jim Kenney here to moderate. So I'm going to turn the show over to him.
Okay, good afternoon, everyone. My name's Jim Kenney. I'm the content provider over at OptionProfessor.com, and we are going to be going over quite a number of trades and information here today. Before we get started, with me today also is Neil Batho of Trader Review. And Neil, if you could give a quick background on yourself to introduce yourself, that'd be great.
Yeah, thanks, Jim. I was a broker back at a major firm back in 98, 99, and it was a fantastic time, and I got a lot of free lunches from mutual funds coming in, selling their products, but I realized pretty quickly that even in the training, they said, you know, you're not really financial advisors, you're financial counselors. Your job is to gather assets from other people's accounts, put them into, under your umbrella. And, I was a lot more interested in the strategy of the whole thing. And the problem that I found in the firm is brokers are all heroes when the market's going up, but when the market goes down, it's almost impossible to call hundreds of clients and convince them why they should sell, because by the time you finish calling the last one, market's already gone down too fast. So it was just really not for me. I was more about the money management. And so I did some business consulting for a while, and then I started my website. And I used the same analysis I used back when I was a broker, which was point and figure charting. Many people in the office using it. And I've been using it to make a lot of fantastic calls over the last 10 years, getting all my clients out before every crash, and always striving to be in the best sectors.
Well, that's great. And people will get a lot of information out of you today, Neil. And we'll be getting to quite a number of the stocks, so we'll get your opinion on them. By way of introduction, I'm Jim Kenney. I do provide the content over at OptionProfessor.com. I've been in the investment business for decades. I've done hundreds and hundreds of seminars educating people on the uses and the risks of option trading. Probably thousands of people have gone to the seminar by now. And the idea is to educate people to the tune of how to use the options for hedging, which I talk about all the time. And, if you've been listening to me at all on the podcast, you will have known a lot of strategies could have offset a lot of this risk that you're seeing. And so basically we try to educate people so they know more about what they're doing, and hopefully that can enhance their ability to either protect their money or make some money. Again, today we got a whole bunch of stocks to go through, so we're going to get started right away. And the first one is the CME Group, which probably is the best looking chart of all of them that we're going to look at today. Neil, don't you think?
Yeah, I took a look before the show, and I kind of wish I got in this a few weeks ago, but it wasn't on my radar, unfortunately.
Well, I'm going to let you go first on these stocks, Neil. So what are you thinking on CME Group?
Basically, what I'm thinking is you got to take into account that 80% of stocks follow the overall market. So unless you have a really unique position in something that's going contrary to the market, you got to be careful. And this stock, for the most part would follow the market, except for the last little while. But when I look at the last candle up here at 196 and the move down, the only way I would want to buy this would be if it broke out again to another high, just to make sure, and I'd want to sell it just below these moving averages, so right around 189.
Yeah.
Back in, I use the cloud. The cloud is good for support and resistance. So
right.
if you get stopped out and then you have a big move down here to, let's say, 175 in the cloud, and you'll get a hammer type candle, then I would get in for a good risk reward trade, and it would have a close stop just below the bottom of the cloud.
Yeah, this stock is obviously in the clearing business and the business of all the different markets that go through it, and a lot of it obviously is the S&P 500. So obviously when the volumes are big and the activity is high, this company is going to make money because there's a lot of action down there, right? My experience is, though, that after you wipe people out a little bit, the volume does dry up a little bit, and the enthusiasm for trading goes on a holiday for a while. And that might not be too far away from what might occur to this stock. We hit the high on this stock only on Monday at 197. And at that point, we were better than 15% away from the 200-day average. Not extremely overbought by any measure, but certainly not oversold or even value. So the likelihood that I think you could look for this thing to decline using Monday's high as a defensible point is maybe not such a bad idea. That coincides a little bit with what Neil's saying as far as going into the 170s possible. And the 50-day average is 179. The 200 days now at 168. So I would think somewhere between 165 and 175 might be a reasonable thing to take a look at if you could get that kind of a drop. Again, if people think that earnings have peaked, if people think that the growth is behind us and the big gains in stocks are behind us, that could slow the volumes. And if you slow the volumes, I'm just guessing, but I'd imagine the CME group wouldn't make as much money as they did when things were going a little nutty. So that's my view, and it pretty much coincides with what Neil was saying, which is that it's possible to get a pullback here, despite the fact that it is one of the best-looking stocks on the board as far as the price is concerned. Not too many stocks. Not too much. I don't know about the 52-week high list, but I'll bet you Monday it wasn't a crowded list. So the fact that it made a new 52-week high in this environment obviously tells you it's got pretty good legs. I think what Neil and myself are talking about is that there could be a pullback.
I was just thinking also, Jim, that this could be a great stock to sell a covered call on, because options are really expensive because the volatility is high in the market. So you could sell a fairly short-term $200 call, and I really doubt that it would get triggered, so you could pull in some cash.
Yeah, by next week, if we don't take out 197, you'll have a weekly chart that has a high, which would be this week, surrounded by lower highs. And sometimes people think that that establishes at least a temporary defensible point. And so that would fit in with the selling a short-term call above 200. And then the other thing is, if you own this stock, you might want to protect some of the values you've got there in a covered call, and using the premium to buy a put doesn't sound like an outlandish idea either. Again, that type of strategy is what I was pointing people in the direction when Amazon was 2050 on my podcast, etc., because we had 1550 as the 200-day moving average. And I've been around long enough to know that when you're that far away from the moving averages, probabilities are definitely favoring a move back toward it. Now, not only did Amazon go way down through the average, but there's a heck of a lot of equity that could have been protected by selling the 2100 call and buying the 1900 put when we were up there. You still would have had further upside if it kept going, but you would have had some floor underneath your equity, a floor that obviously got busted if you didn't have one. So, yeah, the covered call idea certainly makes sense at this point for some people. All right, let's keep swinging here. And next one is U.S. Steel, I believe. And that one certainly has been having a rough time of it. What's your call there?
This is a stock I actually look at every single day for the last couple of years. And what's actually hilarious about this stock is that back right around here, at the beginning of the year, was I think it was right around this time when the steel tariffs were coming in, and you would think that, of course, that would help a steel company, but it doesn't help the steel stock. So the stock will rally up here in anticipation of the tariffs and then sell off after the tariffs, which is a perfect example of buy the rumor, sell the news. Just an absolute classic. So U.S. Steel could definitely be a more profitable company, but it doesn't mean that the stock's going to go up. I mean, it just doesn't. So I just completely avoid it.
Yeah,
Of course. I mean, you get a breakout here above this cloud, maybe 28, 29, and everything's moving in your favor. Then yeah, I will still watch it every day, but I wouldn't buy it now.
yeah, it's got, and the cloud shows it as well. It's got a very pronounced downtrend. It is a company that obviously is probably getting hurt by the tariffs. Two things come to mind, though, or three things actually. One is short interest is 8.51% of the stock, so that's not off the chart high short interest, but it's certainly got a decent amount there, and that means if we did turn around, maybe short covering could occur. Second thing is volume. We were averaging 50-day volume at 7.1 million. Although today was 8.1 million. But the 200-day volume is almost 10 million. So the volume's been drying up a little bit during the selling, which I don't think is a negative. And then the final thing is the 200-day moving average is 34. We're trading about 25, let's say, ballpark. And so that gives you a 26% discount to the moving average. And that is a little bit oversold. So I'm sure the call options are dirt cheap. And obviously, if you're a speculator who doesn't mind, stepping in front of a freight train, which this thing is a little bit on the downside, somebody could make a case that if we had good handshakes at the end of November or some kind of positive news coming out of the relations between the U.S. and China, this would be one stock that could get a pop in it because it is oversold technically. The volume has been drying up. There's a decent amount of short interest. So you've got enough there to have some kind of a pop, at least maybe towards 30 or something like that, if in fact the news got a little bit better out of China and the U.S. That's a big if, so obviously you'd put only your if money in there.
Yeah, I'm looking at the chart for the last since 2003. I mean, this went down to almost $5 only a couple of years ago, and 2003 $10. I mean, it could go to those again. There's no reason why.
It can. It is a stock that has gone in the last 52 weeks, though, from a high of 47. So it is better than half price. I don't know if it's going to be helped by a Fibonacci 61% drop, but again, it all seems to converge somewhere in this neighborhood. Only time will tell. Again, this is very much in a downtrend. You're definitely shooting into the dark, but sometimes things do get it to a point where they get some kind of a turn, and it wouldn't shock me if this 20 to 25 area got some kind of buying activity. But the door is always open for the give up phase where things get even worse, and all of a sudden everyone's coming out of it. So it's a rough racket. It's not something I'd be interested in, but it wouldn't shock me if it got a turn if the China talks with Trump got a little bit better. All right, let's turn to the next one, which is VXX, which I guess is the volatility.
Yeah, volatility. Yeah.
And what do you see here, Neil?
Maybe you can take this one, Jim. This candle, I forget the name of it, but I believe that when you have a gap up and there's an indecision, then that's usually bad, right? Am I right here? So, the VIX isn't something I've really traded very much because whenever the VIX goes up, stocks go down. So I would just bet the downside on stocks instead. But you can definitely make a lot of money on VIX options. But are the VIX options still actually trading? Because something happened a few months ago. Do you know, Jim?
Well, let me just double check here. I'll just hit my option chain and see if
there was an ETF that sort of worked for many years and then it went. Berserk.
Yeah, that was one. But this one here is trading. But there was some kind of a nightmare occurred in one of the other ones. But I'm not 100% sure what it was. It wasn't this one. It was some other short vol thing that I think it was maybe short 3 times vol or one of those kind of deals. But like I say, this thing was trading, down because we had a bit of a rally, and then it's made a turn. This thing looks like it's, gapping up. If I was long stock, this would be very concerning because if it does get above, I mean, this is a breakaway move here. The question is it just a false breakout? And we're going to know sooner rather than later. If we take out 2,600 on the S&P, this baby's probably going to keep going pretty good. And if we go down to 2530, which is what some people think could happen on the S&P, then this thing's probably going to blow out the 42 area there and keep going. So I would find this, if nothing else, disconcerting if I was long stock, because if this thing wants to break out above 42 and start going up towards 50, then things are going to get very sloppy in the stock market. I wouldn't bet that way, but certainly it could happen. And again, this is going up because the stocks are going down. And the VIX that I follow is above 20. Anytime it's above 20, in my view, it's in the red zone. Red zone means that you could wake up and have the thing gap up very much on you, which means you could see a precipitous drop. When you're in the 20s, precipitous drops can happen. When you're down at 15 on the VIX or 10 or 12, precipitous drops don't seem to occur. So the biggest thing I would take away from this is that it is definitely looking like it's trying to break out. And if we're going to go and test 2,600 and then 2,530, there's more upside to come here. If this is a false breakout and we're going to hold 2603 on the S&P, then this thing obviously would have a harder time to hold these gains. Right now, it could be 50-50, but you'll know sooner rather than later, I think, because if this thing can't hold the gain and we turn around, then I think that it would be under the false breakout. Let's turn towards something a little bit more widely held, which would be Facebook. And Neil, how do you see Facebook?
Well, it's really bad, Jim. I mean, we talked about this before the show. A lot of the stocks today are bad. This is a daily chart. It's not showing me a lot. Let me switch to a weekly. Okay, so if I look at a weekly chart, we're starting to get this hammer candle in here, but when something's falling so fast, I never just trust one hammer candle. I got to wait for a couple of them to see what happens. I mean, even if you look back here, there's one huge hammer and then another one. But you're basically in no man's land when you're underneath the weekly cloud. I mean, when you're under the weekly cloud, it's over. It's over for the stock pretty much. Let me look back here how long Facebook stayed above that weekly cloud. It was since 2013, August. So if you're a long-term holder, a great way for long-term holding is just use the weekly cloud, and that's it. And you'd be here in about $30 and out at about $160, which is not bad if you didn't want to try to time the top. But I mean, there's just no way I'd be speculating on Facebook right now. I'd love to short it though, because it's a fairly corrupt company in my opinion.
Yeah, they're definitely being found out
that they disagree with, and I think someone's going to come down on these companies.
Yeah. Well, one thing is that the stock obviously has been sold down dramatically, and I can see there are some high points around 120, 130 from months past. And will it bounce out of that area? Who knows? Again, the best thing I can say about Facebook is that it is getting far away from its 200-day moving average. 200 days up at 175 ballpark area, and we're down at 130. So you're about 25% under. You get 20, 30% under on a big company like this. That's pretty darn oversold. But they've got the kind of news that people don't want to hear, which is obviously the government is kind of going after them a little bit with regards to how they use the data. And they're spending a lot more money than they ever used to. And so that could be the double whammy that keeps this thing in rough condition. But like I say, if you were a believer in the fact, and also I think their users are drying up a little bit as far as either the growth or actually they've rolled over to less users. At any rate, they still got a ton of users and they still got a very big business. And don't they own Instagram as well, right?
Yeah, I bought it a couple years ago. Yeah.
So, I mean, there's that. There's a wild card where you can make there because I've got children and they love this Instagram, I think. So there are some other ways to make money. The way I would probably look for this thing is I would go out a year or 2 years on the calls and see how dirt cheap they could be. And then if I thought it might hold the 120, 130 area, then I might throw some risk capital into a 1 or 2 year option of limited risk. Um, you know, 10 excuse me, 1,000 shares of this stuff would cost 132 grand. That's a dollar figure I would not put in. But 10 call options going out a year or two might cost a fraction of that amount, obviously. And
Yeah.
that might be something that I'd be intrigued with.
Well, whenever we talk about Facebook, it always reminds me when I was a broker in 98, 99, there was a company that went public. I think it was the first ever internet company called theglobe.com. And this was
Okay.
going to be a place where you found everything on the internet at theglobe.com. And eventually they went bankrupt. Then I look at what was the other one? MySpace, got bought for $1 billion, and then eventually it was basically worth nothing. And in all of history, basically all social media companies go bankrupt. And so it's kind of hilarious. I always think of the globe.com, and they said it's all the earnings don't matter. It's only eyeballs. Only matters how many people sign up. It's the eyeballs, man.
Right.
So you got half the world with a Facebook account. I mean, I'm pretty sure growth is saturated.
Yeah, no, they're a mature company. That's the other thing I didn't say that you just brought up, which is great. This is not a IPO anymore. The other thing is it reminds me of Chipotle. If there's a bad story out there on your product, you sometimes have a hard time rebounding from it, whether it's true, untrue, or whatever. And I think there's more truth in these than there was in you're going to get food poisoning at Chipotle or something.
Right. Yeah.
But yeah. So anyway, the good news there is it's way oversold. Are the call options cheap enough? You got to price them out. Do you think it'll hold 100, 120, and then have a rebound because other businesses start kicking in and they overcome these hurdles that are in front of them? If that's the case, then a leap type situation would be worthwhile to take a look into because it would cap your loss, cap your risk, and give you leverage, and you would be buying it after a fairly big drop off the high point. So, with that as a motivation, I could see somebody being interested, but pin the tail on the bottom's a rough racket. All right, we're going to swing now over to some financials. And this is a company I watch very closely because I almost succumbed to the drum beating of you got to get in the banks, you got to get into the financials, which was going on throughout most of the beginning of this year. And that has been a very bad bet. As long as, of course, with the board going like this, there's been many bad bets out there. But this one was uniformly by really sharp characters. In my view, sharp characters. Apparently, they're not always sharp, but they had a good story. Interest rates rise, more profit for the banks. Of course, that means also their costs go up as far as paying for deposits. So I don't know how much that matters. And then loan demand has been kind of weird.
Yeah.
Anyway, I thought this thing was a buy at 250. I was going to try to pick up 1,000 shares. I said I'll keep my wallet in my pocket. Then it went down to 220. I thought that might be a good time to put those 1,000 on. And so money's not burning a hole in my pocket. And ergo, Goldman is not burning a hole in my equity. So what about now? What about now? It's obviously a company that people are selling out of. The other thing that had me in the beginning of the year, I thought this was going to be takeover city by the end of the year because all that repat money was going to come back and they were going to do all these takeovers. And, Goldman will be right in the thick of it, making fees and expenses. And leveraged lending is going crazy. So we're going to do great. And obviously none of that occurred. So today it got whacked again, down 3.5%. What do you think of Goldman?
That's horrible. I mean, you can look here. This is the head and shoulders pattern, pretty much. The pattern is so important that it's the only technical pattern on the Series 7 exam. And yeah, I mean, buy the rumor, sell the news, Jim. When everyone's saying how great it is, and then especially what I've noticed time and time again is whenever there's mergers and acquisitions, that's a market top because people are buying these things with their own stock. And their stock is at a peak. Otherwise, wouldn't they just wait for their stock to go higher? and it's
Right.
happening time and time again. People say, "Oh, we can't grow by ourselves, so I guess we have to buy a company to grow," and then it's over. It's just so yeah.
Yeah.
I mean, if maybe you could short it tomorrow all the way down to 140 or so, could be a good.
Well, I'll tell you right now, there's not much short interest in it. Short interest is only 1.25%, which is a little surprising because this thing has been deteriorating like an ice cube in Palm Springs in the summertime. Just been shrinking and shrinking and shrinking. We peaked out here on March of this year at 275. The darn thing's at 191. It is not that oversold, a little bit oversold, about 20% underneath its 200-day average. 200-day average is 237. But it's certainly not oversold to a point where it would attract me in there. And like I say, they are redefining the company. I guess guys say they're no longer your father's Goldman Sachs. So when you're redoing your company and trying to go,
Bad.
but yeah, no, this thing is every time you wake up, it's a little bit lower. So I don't know where the rush would be to get into this thing, but like I say, it is a bit oversold from its 200-day average. But if that's the only good thing you can say about something, that's not exactly the best.
Yeah. I remember right before the crash in 2008, about a year before, Ford was coming out with a marketing campaign that says everybody gets the employee discount. And I
Right.
thought to myself, this company is in trouble. Why in the world would you give everyone the employee discount? You know what I mean?
Right.
Unless you want the money really bad. And I thought to myself, this is a bad indicator. Something's going to happen in the markets. And sure enough, it did. And you're always going to see this coming with the amount of hubris, I guess it would be called, wouldn't it, Jim?
Yeah.
Just like an Apple, I'm not sure if the stock is there, but I got to mention it. This was a few months ago where Jim Cook was so brazen on the earnings call that he says, I don't like quarterly earnings. Well, okay, I'm not going to say exactly what his words were, but he said that he didn't want to have quarterly earning calls anymore because it interfered with the long-term planning of the company. And I said, that's what the communists said in the 80s.
No, and it's like Apple
with their stupid 100-year plans.
Yeah. It's like Apple not wanting to tell you what the iPhones are doing, even though that's 60% of their revenue.
It's just a classic. So I wrote to my members a couple of days ago. I said, sell Apple. It was my subject of my newsletter. Get out. They're not going to tell you how many iPhones are selling. You got to be kidding me. Imagine Tesla saying they're not going to tell you how many Model 3s they're selling. Everyone would go berserk, but it's the same thing, isn't it?
Yeah, I mean, we've both been in the business so long. We were around when General Electric was considered the best company in the whole country, and
GE Finance. Remember that? They were making more money on finance than on their on all the products they make.
I always thought the big problem there is when Jack Welch went out and bought 417 companies and probably got paid some kind of a bonus for doing it. And then he leaves the company and these guys have to figure out what 417 different companies are doing or something like that.
Oh, yeah.
But, there's always something, that is popular, like Apple is now, where people think that, you can hold it forever. But, people just get, different buying patterns.
I even saw someone said that Apple is worth $1 trillion and we expect it to go up 40% this year. I said, no way, buddy. That's over.
Yeah.
And they were saying how Buffett made $2 billion. I mean, if Buffett is so good at picking stocks, why did he wait until Apple's worth almost $1 trillion to buy it?
Yeah.
and then I saw a report that he had made a few billion and then he lost many billions. And I thought to myself, it serves him right.
Yeah,
it really does.
Well, I think Goldman, like I say, does look like it's getting oversold, but that's about the only thing you can say about it. So obviously, when you look at some of these companies, selling them here obviously is certainly not timely as far as where you should have got out, because this thing has been going down, down, down. As soon as it broke under 250, frankly, it gave you a good sales signal. So we're at 190. If you haven't sold it, where you been? Okay, let's turn towards the next one, which is PANW, which I will officially say I have no idea exactly which one that is. Palo Alto Networks. That's the beauty of having 4,000 stocks out there, is you don't know them all, right? So Neil, that was up today, 231. That's up 1.41% for the day. And what do you see in PANW?
I'm just bringing up the profile of the company so we know what it is.
Yeah, good idea.
Security. Here we go. Security platform solutions worldwide. Yeah. So. Nah, I don't like it. I'll check to the weekly. One of the things, you have sort of these trading paradigms in mind, and is that stocks that are at a great value often become a much, much better value. I think that might be in the book Market Wizards, or I'm not sure where I picked it up, but GE $12 what, a month ago. Now it's at $7, I think. And
Right.
I mean, is it a great value at 12? Awesome value at 7, extraordinary value at 3, a sure buy at 2, and bankrupt at 0. So
I had a buddy who took a shot at Sears at $1.10, and he's the proud owner of worthless stock now. So
yeah, you should have bought the bonds at least, or what?
yeah, they were going to 17 cents on the dollar, and the ones that are coming due fairly soon, and the ones coming due next year were going at 40 cents on the dollar. So they do look pretty cheap, but I don't know exactly what kind of reserves they have to pay those off. But anyway, you have a feeling on this? Basically, you don't like it too much, but it is coming down to where the cloud is. Would that make you any interested in it in that 160 area?
Well, I switched to the weekly chart. So if I go to the daily, it's well below the cloud, and you're going to have different areas, of resistance. The daily, of course, is always the best chart, but sometimes I'll look at the weekly, and if it's bouncing off the weekly strongly, you could get a bounce. Yeah, maybe up to about 180 or so. That actually happened even on the S&P 500 in the weekly when we first started crashing. I just brought it up. I'll make it a little bit bigger as an example, because it did come down right here to the bottom of the weekly cloud, and we got some bounces there. So we have a similar one with A and W. But the weekly chart is not the best for timing, but I think it could possibly bounce if the market bounces.
Yeah, right. And it is getting oversold. I'm looking at a graph here, and the highs of last year in 2017 were around the 150 area. So I would think that if you were interested in this company, if it can hold the 150 area, because it's in an industry that's getting whacked hard, and that's software. And, NVIDIA, you name it, those guys, right? So basically, if it could hold this 150 area, which is the former highs of last year, at 150, you would then be very nicely 25% under the 200-day average. And then if you wanted to investigate something on a limited risk basis, that might be an interesting time to do it if the premiums are very low, and if it holds the 150, and basically you get some kind of a feeling like there's going to be a turn down here, because this stuff has come down from a high of 239. So if you get down to 150, you're 85, 90 bucks underneath the high. So obviously, if you wanted to sell the stock, you're pretty much there. And there is some reason where it could bounce technically because of the highs of last year being support, possibly. But that's the only way I would view this. But again, it's in the free fall area. Today it was up 231. It did hit a low today of 160, and it closed up near 166. So there was probably some short covering and stuff like that going on here. But that's pretty much the story as far as I can see. You got anything else to add on that one?
No, I've already brought a Costco chart up.
Okay, that's seeing on Costco.
So I'll start on Costco.
Yeah, please.
It doesn't look very good, and I really hope that they still keep serving those snacks if the stock goes down, for when I'm shopping there. But this is a potential triple bottom here. And you got to remember, these things can sell off, man. This could go drop down to 190. I mean, if it starts aggressively selling through here, my favorite, if it broke through here down to about 210, then back up to 220, then the next move down. But again, you have to go with the market on a stock like this. A stock like this just follows the market. I mean, look at almost exactly how it followed the market. Yeah. And I just want to say to everyone, make sure you never chase yield in a bear market, because these companies will drop the yields. And I just want to check what the yield is on Costco.
Not too much. I got it at 1%.
Yeah.
So it's
Yeah, I didn't think it was. I knew it was something.
Now, people buy into this because the retailers were doing great, and this is a cheap place to go. So Ross Dress for Less, and Walmart and Target, they were popular because people are out there spending, but they're also being price conscious. This company peaked in September at 245, and it has not seen 245 since. And basically, if it takes out, well, actually, where it is even now, it's getting into where, obviously, today it looked like it gapped down. So it's got a chart formation that looks like a double top up there. And if it takes out that center point, which I think it's in the process of doing right now, then it could accelerate to the downside. And there is some support, I would imagine, around 200, because that's where the highs were earlier this year, where it took off from. Again, the moving averages are 209 on the 200 days. So, that would be the neighborhood where I would probably put the periscope up. Right now, I'd keep the periscope down because I would see if there's a little bit more to follow here. But again, up at 245, you're 20% above the moving average. 20% on a big company like this is a lot. And so it's extended up there, and people have changed their tune on the consumer, as you can see from the retail index, right? So obviously they're not quite as boom, boom, boom that the consumer will just go out there and keep spending. Now they're worried about how much credit card debt they probably rang up to get this thing going where it went. So, the tides change, and, we'll have to see who's swimming naked here. But Costco looks to me like it has had a double high up there, a little bit less of a high. And if it if it really gets through this 210, 215 area, going down to 200 looks like the next stop where you'd at least take a look at it and see what it looks like.
You know what, Jim? You just gave me a fantastic idea. It's one of the best indicators I've ever thought of for the overall market, and that would be if we could somehow chart all of the purchases on all the Costco credit cards.
And give us an idea of what kind of credit card debt there's been.
Yeah, the debt, and also how much people are just buying crazy things, like they're going for a bag of rice to come back with a trampoline. You know?
Exactly. And also, I was told, or I had listened to someone who said that there's some kind of number like 49% leveraged for the Chinese consumer, and our consumer is 77% leveraged or something like that.
Yeah.
And so obviously, that's one of the reasons these things are breaking as well, I think, is because they're concerned that the consumer is a little too leveraged for an economy that may be slowing next year or normalizing. Let's just say, call it normalizing, which means forget about the 3.5%, 4%. We're going to go back towards 2.5%.
I got to say this, even though we're just supposed to make stock picks, but the days of using your house as an ATM machine are over.
Yeah.
And they're going to be over for the next 10 or 20 years.
Yeah.
You know? I mean, I remember I had to look this up, but back in 98, when I was a broker again, I always talk about it, but mortgage rates were 8%. Houses were really cheap. We're talking a house that cost 800 today was 200 back then. And I mean, just sure as heck didn't go up 400%. But then you had this thing where people are just all of a sudden getting this equity out of nowhere. And I'm pretty sure in my accounting classes that I was forced to take, unfortunately, because I did finance, but we had to do accounting as well. I don't think there was such a thing on the balance sheet as fake equity on a building that you own. So if you bought a building back in the 80s for 200 grand and it's worth $1 million today, on your assets, you still only list it as 200 grand. You don't list it as 3 million. I'm pretty sure. Do you know, Jim, the answer to that one?
Not exactly. Yeah.
I think you had to list it at what you bought it for, but now people say Your house is worth a couple of $100,000 more. You want $100,000 loan to buy a boat, do whatever you want, build a deck, and that's over. And that's going to hurt the economy bad.
Or you can buy your reverse mortgage from Tom Selleck, who's on TV all the time, right?
Oh, I missed that.
Yeah, he's doing reverse mortgage ads now.
Oh.
At any rate, let's keep this ball rolling so we can get through a few more here, and we can go through these pretty fast if we don't have much to say. Solar Edge Technologies, not a company I'm familiar with, but what do you got here?
Okay, hold on. Yeah, it's not something I would be too interested in right now, mainly because it follows the market.
Yeah.
And, also, when oil is weak, people aren't going to go to solar. It's just the way it is.
Right.
Unless, the municipalities and whatnot are going to mandate solar panels on every new house, et cetera, et cetera. But it's basically inversely proportional to oil. So oil goes down, alternative energy just goes down. So, that's a good fundamental tip I put in there.
Yep.
But no, I'm not interested in this company right now.
Right, and the only thing I can say is that it's 25% underneath its 200-day average, so it is getting a little bit overdone, but not too bad. And it does have high short interest. 25.5% of the stock is short. So, bottom line is it could it have a short covering rally at some point? I guess it could. And is it getting a bit oversold? I guess it is. But again, that's just sticking your head into the dark and hoping that nobody bites it. Let's go to the next guy. And that's going to be your pot stock. Anybody want to talk about the pot stocks? Here we go. Tilray.
I don't know. I'm not an expert in this kind of stuff. It's pretty new. But I think this is a typical example of buy the rumor, sell the news. Just like anything, back here, you're buying the rumor. And what are you going to do now? I mean, you got your neighbor who doesn't invest in stocks. All of a sudden, he's going to ask you about pot stocks. And that ship has sailed a long time ago. So
it actually smells a lot like a Bitcoin, in that you get a lot of people in there who don't really understand it, but they're bidding it up. Yeah, I mean, it went from $20 in July to $300 in September, and now it's at $100. So if you're going to get into this thing, you better be using some funny money, and also you better keep a seatbelt on, because volatility or principle is going to be just off the charts. But if you're a believer in the thing, you might go with a fund that has a bunch of these in there, and then you could mitigate your risk by being diversified. But obviously, if you bought it at 20 and went to 300, this is the best deal in the world. If you bought it at 300 and now you're at 100, you probably have a dartboard with Tilray stock on it.
Yeah, I think you might be able to get rich in the next couple months or years of buying puts on pot stocks and shorting the heck out of them, because the story's over. Buy the rumor, sell the news. And
it's hard to predict which ones are going to come out the other side. There are some stories that I've heard that are somewhat compelling, but it's hard to really be too definitive on something where the market cap is $9.9 billion and their revenues are obviously a very tiny fraction of that.
Mm-hmm.
But let's keep going to something that they might like. KEM, and KEM is Comet Corp, and that was up a little bit today. So what do you see with Comet?
Really strange chart. Do you know what this company does, Jim?
The industry group that they're saying is Industrial Electronics, which was the same as the former company, Solar or whatever.
Okay, my guess is that the person that asked for this stock, they probably own it.
Yeah, I would imagine.
They probably work for the company. So if you could hold it here, and then let's look at so oh my God, way back at $1.80. And so either they hold it or they have some options, but I would hold it. And if it breaks past this level, about 15 back here, that would be sort of a triple top break. And if it breaks down to around the $13 level, then I would definitely just get out. And Yeah, or even if it breaks here down to about 15, I would also get out. This is what I see. Yeah, because a stock like this, I mean, don't think these stocks can't go down to where they were before, because they certainly can. It happens all the time. Happened to AE from $40 to $2. It happened U.S. Steel. I think even U.S. Steel was $100 down to $10. So don't think it can't happen to you. It can.
Yeah, nobody likes to buy insurance, but it sure comes in handy when a storm hits. And so this thing here looks like the 52-week low was December 7th, which is a day that will live in infamy, right? Of 2017, and it was at 1375 ballpark number. And the chart that we were just looking at, it looks like if it blew out the 52-week low, that they'd be saying sayonara to this thing pretty heavily. So if you own this thing, I don't think investigating some type of a limited risk put as insurance would be the worst idea in the world. And so I would, have some type of a hedge underneath there, just in case something gets happening here and it blows out the 14 area and goes into the abyss a bit. But because, like I say, it looks like you've got a double low there. But if it gets blown out, there's all kinds of numbers between 0 and 7. You know what I mean?
I would also sell it at 25 if it rallies back up, 25, 27 area. This would be an awesome place to get out.
Yeah. Well, like I say, if I was to be a buyer of this thing, I'd certainly like it to take out the 200-day average, which is 21, which is probably the short-term high that it hit recently. And then you could maybe make a case for a 1, 2, 3 formation where the low got hit, and then it ran up, and then it pulled back, didn't take out the low. And if it takes out that reaction high, then maybe you're onto something. But it's not a company in my universe, so I wouldn't opine too heavily on it. All right. How about TAL? Travel Centers of America. Are people going anywhere or not? Looks like they are not going anywhere.
So TAL is the symbol. Okay.
Yeah.
Education group. What do they do?
It says consumer services. I thought it said something about travel, but I'm not certain. Right now, it just says that the education is consumer services. Well, the consumer is not doing very well on the on the XRT, and this thing hasn't been doing well in a while.
The $15 billion market cap, which is pretty big. Oh, it's in Beijing. Tutoring.
Okay, after school tutoring, right?
Okay. Well, the worse the economy. Well, it's a bit of a catch-22. I don't know if it's catch-22 is the worst one, but if the economy is doing great, parents will pay for your tutors. But then I guess if the economy is doing really badly, then they'll really pay for your tutors, right?
Well, I think this has a Chinese angle. I thought I saw when I was reading the blurb you had up there that there's a Chinese angle. So I guess there could be something if there was some positive news coming out of China-U.S. relations that might help this thing.
Yeah, I remember a Chinese education company from years ago. I think it was ticker was EDU. Is that? Yeah, New Oriental Education. Here it is. So pretty similar, but no, I would avoid. I mean, it kind of feels to me like the person asking for this stock is maybe trying to think of a fundamental point of view, but the charts will trump the fundamentals 100% of the time, because the chart knows something that you don't know or you didn't think about, and it's also based on future expectations as well. So no, I'm not interested here unless it would break out to maybe 31 could be a buy, but there's nowhere to short it in here.
Well, I think the reason that it bounced off 20 after that kind of decline from the high of 47 is it got about 40% underneath its 200-day average. Again, when they get way away from their averages, it tells you a couple of things. One is that you probably are exhausting the volume in that direction a bit. And when you exhaust the volume, obviously, if there's any volume coming in on the other side, there's no liquidity for them. What does that mean? If we're tanking stocks and every Tom, Dick, and Harry's selling out, and then the selling dries up, right? And then some guys want to buy. Well, if the selling's all dried up and now everybody wants to buy, you got your order imbalance the other way, and that's how you pop. So basically, everybody sold out of this thing between 47 and 20. And then obviously, some people wanted to do some short covering or something else because maybe they're getting a little bit more positive on China. They look at BABA, maybe holding that 130 area or something else. And so they popped the stock from 20 back towards 30. Now it's back at around 26, 27. So it's a little bit in no man's land. The highs of mid last year were around 20, so that's probably why it held that area, or it had some reason to bounce. That and the fact it was 45% or so underneath the 200-day average. But now it ran into 30, and it has turned around a bit. So I would use 30 as a line in the sand, and I would be hoping that the meeting at the end at the G20 meeting was a friendly one. And if that happens and it took out 30, then you might have something that could at least give you some kind of a trade. But the overall flow of traffic with the cloud and the moving averages is down. So that's the main controlling factors right now. All right.
We haven't reached capitulation in stocks, but we will.
Yeah. With regards to the Qs, which lost 3% today. At least I heard they lost 3%, 2.9. Yeah, they were down 290 on the Qs, but the actual Nasdaq index was down 3%, I think. At any rate, what are we seeing on the Qs here?
I'm kind of almost thinking stocks could rally tomorrow because this is the opposite of that chart we looked at before, where there was the pop up in the candle that couldn't make a decision, and that's what this happened today with the candle that could not make a decision. So let me just look at maybe the 5-minute chart just to see what it looked like today. So yeah, a gap down and then nothing. And then you compare it to the S&P 500. But I would bet on the Nasdaq over the S&P 500 for any type of rebound. But I mean, if you want to play this to the upside, I mean, you have to wait till it hits maybe 161, or you could, yeah. What do you think, Jim?
I think it gave you a sell signal at 180 on the break, and then on the rebound back up, it couldn't take out the lows that occurred back in August, July at 175. So that was another opportunity there. And now it's a little bit in the abyss. Let's check out how far away it is from the moving averages, because again, let me just see here. We're at 170. Yeah, I mean, the moving averages are still, this is why you can't just use moving averages. They're still in a positive light from the standpoint of the 50 days still above the 200-day. Yeah, I mean, could it bounce out of here? I guess it could. Why would it? Again, just calling the dogs off, on a short-term basis, the volume might be having some trouble. But I've noticed the volume. Well, the volume today was 99 million. And the average volume for the last 200 days is 45 million.
Wow.
So that would add some credence into the idea that we had a high volume sell-off today, and that if they've exhausted on a short-term basis the sellers, and you get some people who want to do short covering, they'll pop it. And that's possible. I always see Thursday and Tuesdays as being reversal days. So they may turn it around on Wednesday. But if they didn't, by Thursday, if they can't reverse it up at all, boy, that would be a negative. And of course, this Thursday we've got Thanksgiving. So that may make Wednesday the day that they turn it up. But at any rate, yeah, that's just hoping against hope again, because this thing is definitely on the defensive. 175 is a pretty defined resistance right now, because your 200-day and your 50 comes in right around 172, 176. So in that 175 neighborhood, until we got above that, getting bullish on the Qs is probably a little bit risky.
So Intuitive Surgical is the next one.
Yeah, what do you got?
Pretty similar. It looks a bit stronger than the rest of the stocks we've been looking at lately, because the medical field is, I think, one of the best sectors you could possibly be in. It's set to grow at twice the rate of the overall economy. So, is it a buy? No, it's not a buy. I would want consolidation for a few weeks and maybe a move up to 540 or so before I would be buying. But if I'm holding, then I would hold, and I wouldn't get out until it made a move down to about 460.
Yeah, it did pop under. It went under the 200-day average and then closed right above it a little bit, or right at it. The 200-day average on this is 485. The 50 days at 532. Medical equipment supplies, the healthcare sector, has been one of the stronger ones. Obviously, demographics and the fact that it still costs $75 to get an orange juice in a hospital and that kind of thing. There's still a lot of profits out there for these guys. So bottom line is that this company's had a huge run, though. I mean, let's be frank. In 2017, the thing was way down, and then it has come up all the way to almost 600. So you were way under 300 in 2017, and then you're almost at 600. So this company is 55 billion. It's a good size one, but like I say, you can see it's a little bit overdone from the cloud. Again, if you want to use a line in the sand, the 52-week high is 581. So if you own the stock and you wanted to sell calls above that on a covered call basis, that might not be a terrible consideration. And if you want to take those calls and put a stop or put a put at 450, 460, today's low was 462. I think if you start taking out today's low, then this thing could even go down to 400. So the bottom line is this might not be a bad collar right here, because it looks like the highs might be in short term, and it looks like you could use some insurance if it gets much lower. So this one really might be something to collar if you own it. And if you own it and you don't want to collar it, investigate a little insurance under 450, 460, today's area where the lows were. Let's take a quick look here and see what Google's doing, because Google's always one of my favorites here. I thought it was going to be a bargain at 1,000. Well, looks like it's just about there to be a bargain, 996. I thought that's where it would stop, and it did stop there. I don't know if it's just a pit stop or if it's at least a semi-permanent stop, but I did think the 1,000 area might be interesting. What are you seeing on Google?
Yeah, I mean, it's better than Facebook. I mean, everywhere you go, there's always those Google ads. But if I'm looking at it from a fundamental perspective, I mean, stocks move. My hypothesis is that stocks move based on earnings growth rates and earnings growth rate expectations. So how fast can the earnings grow on Google? I'm not sure all that much faster, but you have this sideways support, which I never like to use as real support. But I wouldn't sell it here if I was buying, and I would put a stop around 980 or so. But
Right.
no, definitely wouldn't be buying.
Yeah, I mean, obviously you're fighting the tape here as far as the momentum is concerned. So on most of these stocks that we're discussing, the momentum has definitely gone down. The thing is you're trying to play the guessing game of, is down far enough yet? And that's a very difficult game and dangerous game to play. What some people try to do when you're in the abyss a little bit here is they look at the long-term equity options, and the reason they do that is they figure that life will go on, and after these kind of big drops, it's possible that some of these higher quality companies might be able to turn around and do better, because the world doesn't come to an end no matter what happens to these stocks. So Google does have YouTube, and it has other ways of making money, and they are not they're a search engine extraordinaire, and they're not in the same camp as some of these other guys. And the PE ratio I'm showing is 38-1, which seems a little elevated. And that might be the real problem with Google, as much as anything, is that it has a little bit of an elevated PE ratio. And PE ratios that are elevated have been punished. Things like NVIDIA, of course, and your Amazon being two of the more egregious cases of higher PEs. But
I think
the cloud doesn't look any good. So basically, like I was saying, you're trying to think that it will stop on a point. And again, like Neil just said, the 52-week low is 980. So that's a line in the sand if you want to make it that. And might not be a bad place to have some type of a hedge going at 980, just in case things are to get worse than we anticipate right now.
And you got to look at these trillion-dollar market caps, because when Apple hit $1 trillion, I knew that Google wasn't that far behind. So it's 715. I think it was around the 900 something level.
Right.
And so these, it used to be the 500 billion market cap. I remember Cisco was the first one, I think, to hit that back in the late 90s. And I think it took 10 years. I don't even know if it ever went back. So Apple hit a 1 trillion and Google close to a trillion. I think in 10 years, you may not see this stock any higher than it is today. If you look at history, you look at Cisco, it never happened, and a few other companies. I think even GE hit 500, and now it's like, what, 50? So,
right.
Yeah. I mean, if I was an MBA student and I'd be going to Silicon Valley and trying to get funds for another search engine to compete with Google, because I think people are sick of Google, they're sick of the censoring, they're sick of the management. They know what their agenda is, and you only use Google because you kind of have to.
Yeah, you need to. Well, we're trying to wrap it up right now because we're right on the 1 hour mark. Neil, can you tell everybody how they can get a hold of you and anything you got coming up?
Yeah, sure. Just go to traderreview.net, sign up. You get my best ETF for the year. It's got the best fundamentals, and and I send out a good free newsletter if you want to sign up there.
Okay, great. And again, I'm Jim Kenney. Every week I've got a podcast on Fridays. If you'd like to get the link, just go to Option Professor, OPTIONPROFESSOR.com, and click on there, and you can get the link for every Friday. And I give you my opinions only, obviously, and my views. And again, with the options, when we're up at the highs, I was explaining to people how to hedge their portfolios with collars and married puts. That direction that I was pointing people to investigate was a very good direction. And now, with the markets way down, people who are thinking about selling out of everything or who want to maybe get in but they're afraid to, I am suggesting you investigate long-term equity options because if you're going to sell out of everything and you're selling out at a terrible time, it might be good to replace some of those exposures with limited risk options way out in time that would cap your exposure and make you a little bit more comfortable on your cash risk that you're taking. And then, of course, obviously, if the premiums are very, very low because the markets have dropped, that makes the long-term option interesting at that point as well. So again, thank you all for being here. I'm going to turn it back over to David. And again, don't forget this Friday we're going to have the podcast. So I hope to have you all with us for that.
All right, thanks, guys. Got through almost the whole list this time, so that was good. Just a reminder to everyone. Be sure to subscribe to Timing Research on YouTube. I'm getting close to 1,000 subscribers, so if you haven't subscribed yet, that would help. And also your favorite podcast network. Just search for Timing Research and subscribe, or you can go to TimingResearch.com to get access to any of the past shows or reports there. Be sure to join us next week for the last shows of November. That's Crowd Forecast News on Monday at 1 p.m. Eastern Time. And Analyze Your Trade Tuesday at 4:30 p.m. Eastern Time. Jim will be back, as well as Norm Hallett, John Thomas, Larry Gaines, Matt Buckley, and Andrew Keene between those two shows, and also a first-time guest, Jeremy Newsom. And just want to thank my guests again for this week, Jim Kenney of OptionProfessor.com and Neil Batho of TraderReview.net. Thanks, everyone.